In this video, we are going to talk about Exxon stocks analysis. So before starting this video, please like this video and subscribe to this channel for our future updates. ExxonMobil, XOM, has increased its share price by 36.36% from the beginning of the year to April 7, 2021. The oil major delivered an impressive total return of 38.46% when quarterly dividends of 87 cents per share were factored in. As dividends are taken into account, the S&P 500 is up 9.06% year-to-date. Exxon easily outperforms the sector index, Fig.1. When XOM was kicked out of the Dow Jones Industrial Average in August 2020, no one could have predicted this. Given Exxon's recent momentum, it's normal for an investor to wonder if now is a good time to buy for the long term. I try to address the question in this post. XOM makes a comeback. I assume the rising oil price is the key explanation for Exxon's recent strong results, based on the fact that XOM moved in lockstep with the WTI benchmark, Fig.1. There are a few other variables that may have led to XOM's rapid growth. To begin with, Wall Street has warmed up to the oil patch once more. Crude oil experienced a remarkable upswing from 1998 to mid-2014. With WTI rising from below $10 per barrel to a sustained plateau of around $80 per barrel, interrupted only by two brief bear markets, from late 2000 to 2001, and from mid-2008 to early 2009. XOM soared beyond $100 per share on the back of rising oil prices, Fig.2. Then, in mid-2014, crude oil prices plummeted, kicking off a 7-year bear market that has only recently ended. ExxonMobil had underperformed in the past 6.5 years against the backdrop of this stubborn bear market, Fig.3. Exxon turns out to be yet another cyclical company, despite its enormous size and world-leading technological capabilities. However, since late 2020, Wall Street investment banks have changed their views on crude oil from bearish to bullish, with some even forecasting that WTI will end 2021 at $70 per barrel. With a slew of improvements, such a bullish attitude has been projected into Exxon's outlook. Even though Exxon's recent financial results are as bad as they can be, the smart money went long when the business climate began to change, as with any other cyclical investment play. Second, a major turnaround plan is currently in progress. Previously, ExxonMobil made a series of questionable purchases at the peak of the previous bull market, such as the $41 billion purchase of XTO Energy in 2010. Exxon began writing down reserves in 2016 as a result of low oil prices and aggressive reserve booking, culminating in a massive $26.5 billion asset impairment in 2020. As a result, the asset quality in the book has significantly increased. By the end of 2021, Exxon expects to slash more than $10 billion in operating costs and lay off 15% of its global workforce. Exxon decided to slash capital spending and retain dividends in response to pressure from institutional investors such as D.E. Shaw. It will have a disciplined, flexible capital spending plan for 2021, $16-19 billion, down from $21.4 billion in 2020, with Guyana, Brazil, Permian, and chemical performance products as a priority. Under the plan, dividends will be maintained at $45 per barrel Brent oil price and 10-year low downstream and chemical margins, and it will slash dividends at greater than $50 per barrel Brent oil price and 10-year low downstream and chemical margins. Through 2025, its capex will be $20 to $25 billion per year, with an emphasis on low-cost, high-return ventures to boost cash flow and earnings. According to Darren Woods, the company's CEO, recent exploration success and lower strategic investment growth costs have increased the value of our industry-leading investment portfolio. Continued focus on high-grading the asset base, through discovery, divestment, and prioritization of advantaged growth opportunities, would increase earnings power and cash generation, as well as rebuild balance sheet ability to handle potential commodity price cycles while working to keep a consistent dividend. Many of our businesses' prices and profits have increased since the third quarter, and when combined with ongoing measures to minimize spending and gain additional efficiencies, quarter-to-date cash flow has exceeded our expectations. In other words, by 2020, most of the negative news had already been factored in, and things were starting to look up. Finally, ExxonMobil appears to have softened its stance on greenhouse gas emissions, allowing ESG-focused institutional investors to invest in the company. In accordance with the Paris Accord, it now pledges to work to minimize environmental impacts and climate change threats. It published a study on sustainability. Its subsidiary XTO Energy increased its commitment to reducing methane emissions by joining the Environmental Partnership, a major industry initiative aimed at reducing emissions from natural gas and oil production. It named ESG hedge fund manager Jeff Ubben to its board of directors, a decision that was well received by investors, as shown by the share price increases that followed the announcement. There are a few main uncertainties to keep an eye on. Long-term investors should keep an eye on the following important issues in the future. ExxonMobil is a winner when it comes to climate change. First, how can Exxon replace reserve depletion and sustain a flat oil and gas output profile now that capital expenditures are limited by environmentalists' call to decarbonize and institutional investors' demand for more free cash flow? ExxonMobil has a disciplined capex plan of $16-19 billion in 2021 and $20-25 billion per year through 2025, with an emphasis on low-cost, high-return ventures like Guyana and Permian growth projects to boost cash flow and earnings. Exxon would have to show that under such a capex strategy, it can keep production stable for the next few years. Second, how can Exxon reduce costs, increase margins, and produce more free cash flow in the future? Exxon cut annual cash operating costs by $8 billion, 15%, in 2020, with $3 billion of that coming from structural cuts. By 2023, it plans to save an additional $3 billion in structural operating expenses, bringing the overall annual structural savings to $6 billion compared to 2019. Finally, how will ExxonMobil enforce its climate initiative when growing the company in the future? ExxonMobil is not as aggressive in lowering greenhouse gas emissions as some of its European peers, which are currently reducing their fossil fuel exposure by divesting oil and gas properties. ExxonMobil's energy mix forecast may give the impression that oil and gas are being phased out. Oil and gas demand will begin to decrease only when global energy usage increases at a slower rate than 0.65% per year. Assuming that the global economy grows at 2% per year in the long run and that the energy elasticity coefficient, i.e., the percentage change in energy consumption needed to achieve a 1% change in GDP, remains about 0.5, oil and gas demand which continue to grow at 0.35% per year. Oil and gas demand will likely increase by 2.33% per year under more likely projections of 4% global GDP growth and 0.75 energy elasticity, Fig. 0.4. In the long run, I don't think Exxon is as good a business case for controlled decline as many people believe. I assume the company will restart production expansion at some point in the future. Estimation. Let's calculate ExxonMobil's intrinsic value in three scenarios. The cyclical as usual scenario, in which the company raises dividends at a rate of 7.7% per year, as it did between 2004 and 2020. This implies a cyclical business climate, which has always included oil bull and bear markets. The corporation would collect dividends at a rate of 6.0% per year in the middle case. This is the point where the perma-bear and cyclical as usual cases meet in the middle. These three scenarios are focused on the IPCC lower 2 degrees Celsius scenario's global energy demand forecast for 2019 to 2040, Fig. 4, and the expectation that Exxon's dividend payout situation would improve as an oil bull market unfolds. I arrived at the following net asset value by assuming a 2% annual decline rate for the terminal value after 2040, using a 10% discount rate, and taking into account the net debt. In the perma-bear scenario, each share of Exxon is valued at $39. In the past, XOM briefly fell below $39 in March and October 2020, before finding double-bottom support at $31. ExxonMobil's stock is expected to be worth $49.50 in the midpoint scenario. ExxonMobil's stock is valued at $62 per share in the cyclical as usual scenario. XOM is currently trading at a 10% discount to its midday April 8, 2021 share price of $55.76. Takeaways for investors. Based on the above analysis, I assume the best entry point, $39, is likely to have passed us by. On the way in, a long-term investor should always demand a sufficient margin of protection. In this situation, the margin of safety emerged in March and October 2020, when the market believed Exxon would be stuck in a never-ending bear market. Existing ExxonMobil shareholders will be pleased to learn that the stock is actually undervalued, making it a good buy if the investor thinks oil is entering a bullish period. To be truthful, I don't believe that large size equals dividend protection in natural resources investing, and I definitely don't believe that large cap stocks offer high alpha. As a result, instead of XOM, I have a range of other stocks in my portfolio that, in my view, have a much better risk-reward profile. However, that is beyond the reach of this post. What do you think about our video? Have you got profit from investing in stocks? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.